increase price action. What happens is that the volume dies down and the buy orders typically start to decrease, and there's more sell pressure than there is buy pressure. It'll form typically what's considered a doji candle. This is basically where you've got two wicks with the bar in the middle. And it's basically, typically what that says is there's indecision. You know, it could go either way. However, when you've got some bullish candles leading into a doji, that means that typically there's a reversal coming, because the sell pressure is much stronger than the buy pressure available. So that basically means, okay, price is likely going to start falling because the order books on the buy side aren't filling up as quickly, and so it leads us into a state of indecision. Now, it doesn't always mean that, but for the majority of the time, that's what you're looking for. And if you move next, so if we're coming off of a bullish candle or a series of bullish candles, and we see this indecision indicator go off, being the doji, I give that a thumbs down, because typically that means that it's likely to reverse to the downside. And in this case, it did. And then after some bearish activity, we get another doji. This doji, on the other hand, is basically saying, okay, well, the buy pressure is picking up, which is removing the strength of these bearish candles, and we're likely to see a reversal, at which point we did. Now, you can try to eyeball those, but those aren't necessary. I mean, those aren't as accurate, because they're indecision candles. They're basically saying, look, things could go either way, but if you're trying to play those candles, that's, you know, some people play them to the up or the down based off of what happened prior to that candle forming. Now, moving forward, we see some bullish activity. Or I shouldn't even say bullish activity, but we see some increased price action. The price is rising a bit. And then we see our first bearish hammer candle. And the hammer candle is typically pretty accurate in determining whether the prices are going to move up or down from there, again, based on the previous momentum. So we had some increased price action. We saw then we see a bearish hammer candle. Now, this is typically saying, okay, we are going down from here, to some degree. And then we do. And so, you know, typically this would be considered a doji candle. And it is, but this is it's red. I mean, it's basically, we're going down. The indecision is that, you know, the increased price action leading into this doji basically said, okay, now we're meeting in the middle before a complete crossover. And this is on a 4-hour chart. So at which point, you know, you've got the bearish handle, you've got a doji, which I would consider a bearish doji candle, because of its position here. And then, of course, we do see a pretty significant drop in price action. Then we get this doji candle, which is saying, okay, we're undecided, not sure where we're going, could be up or down, but because it's after some very bearish activity, this indecision is basically signaling, hey, we might go up from here. And then you get this doji, or this hammer candle that I would consider a bullish hammer candle. And then we, in fact, do go back up. So hopefully that makes sense for everybody. Basically, the longer the wick on a hammer candle, typically the more accurate I would consider it to be. And the more volume we have in this, I would say, you know, that leads me to believe that it's going to be a little bit more accurate. Candles like this are still kind of iffy in a sense, right? Like, you've got this here. This is basically just a big drop and then another big drop. And you can see that the volume and price action on these candles continues to condense, which means that the the sellers are selling off until there's more buyers. Once buyer activity starts to pick up again, these candles will start to dissipate in strength, lead us into indecision, a reversal hammer stick candle, and then boom, we'll start getting some reversal activity and price action, and away we go. So again, in cryptocurrency, anything could happen at any minute. But typically when those things happen, it's far and few between. Like you can still scalp fairly easily in the cryptocurrency markets. It's the big swing trades that I find to be a little more dangerous in the crypto field, because it seems like swing trades are when everybody comes together and starts forming these expectations of future price action that I see the whales taking advantage of. And so you're going to see these giant swings like this. Now, this is a pretty steady string. Each one of these candles is a 4-hour period of time. So whether it's a whale dumping through limit orders or what, I am guessing that this is a point where, look, we see our resistance levels here, and we just kept bouncing on that for a little while. We broke above it for a minute, but then it didn't do anything. We didn't really clear it. We didn't get a candle close above this resistance level, so it didn't actually make it support. And so at that point, we just continued to kind of, almost like a buoy in the sea, just kept bouncing up and down until we finally decided to break through this support level and continue further down. And then we broke through, here we basically start a new trend. So this becomes the resistance. This became support. We wicked on this support level before we bounced off of that. So you can kind of get a gauge as to where the price action is typically expected to flow to and from within a particular channel or within a particular trend. So that's ultimately the hammer stick strategy that can be pretty fruitful, especially for easy, quick scalp trades. So stick around and I'll be back with the next strategy. All right, ladies and gentlemen, we're going to go over basically trading hammer candlesticks at trend lines, and kind of going over a few different things in this. So the first thing you're going to see is we've got two trend lines. We've got an uptrend, and then we have a downtrend, okay? And then we have what was, really would have been considered a bullish pennant, I think, bull flag. Typically, we'll start at the beginning. So basically, if we start down here, we drew this trend line. We've got the bottom, right? It was a wick bottom. And we drew this line to touch on we had multiple touch points to establish this upward trend line. And it went all the way up here, and it got touched a couple times in here as well. So we have a bullish trend line, and in that, what we're looking for are hammer sticks. So when the price drops and touches the line, we're looking for bullish hammers to signify that the price is going to reverse at that point, and we're going to continue on in the trend. And that's basically what we saw down here. So if I'm watching this trend line, I'm saying, okay, here we get what appears to be a doji, this candle of indecision, and then it moves into a bullish handle, or a bullish hammer. Jeez, getting all these little terms out. So anyway, but because we've established this trend, we know that this is likely going to be a price reversal to the upside, because it's going to continue following the trend up. We'll have a little dip in price action here, and then we have another hammer candlestick, and it reverses into more, and so forth and so on. And you could potentially just trade these. Realistically, though, to me, while you could trade those and make little tiny scalps of profit, right? Like this here's on a 4-hour. If I'm buying down here, I'm just going to hold. I'm just going to hold until this trend breaks. And so, you can improve your positions a little bit, but to me, this is one of those scenarios that You know, they say somebody who buys and holds typically does better than somebody who's trying to swing trade their positions to improve accumulate whatever the position is, because mistakes are made. It's almost like car accidents, right? I kind of attribute this to car accidents in the sense that, you know, they say, I forget what the percentage is, but a very high percentage of car accidents are when people are changing lanes, right? If you just stay in your lane, you statistically, it's proven you're going to do significantly better over the long run. Rather than somebody who's changing lanes constantly, you're more likely to get in a wreck. Okay? And I believe that something like that bodes true here as well, especially if you've already established an uptrend and you know you're on an uptrend. Why would you swing trade this at all? You just buy it at the bottom if you can, or buy it at one of these points and then just hold and ride the trend all the way up. And then we come to this pennant formation, where typically this would signify, something bullish, right? Where, you know, you're coming off of a bullish trend, you're establishing some more accumulation, and then typically you can break either way. It depends on the market sentiment at the time of the accumulation. But looking at this price action, you know, you see that it kind of wants to break down here, but it doesn't. And it stays within the trend until, you've got your candle of indecision, and then you've got a giant hammer that just comes down and crushes the price. And this ultimately starts a downtrend, right? The same bodes here. You know, if I'm up here and I'm seeing this, I'm likely, you know, chances are when I've risen to this point, I'm increasing my stop loss this whole way. I'm going to get stopped out at some point in here. And at that point, I'm watching these. Maybe I'm playing these candles because if I get stopped out here, I'm probably going to feel like, all right, this is a really good buying opportunity. And it would have been. It is. You buy back in here, you've made some more, you've increased your position. You ride it up to here, you're changing your stop losses. I mean, this is how you trade. This is how you're scalping. This is how you're day trading. These are the kind of moves that traders make. And as long as you're making more profit than you are losses, you're good. And you just keep pushing forward day in and day out. But then once you get to this point where this price action, it starts to accumulate and the volatility starts to waver and kind of thin out. You know that this is a breakup of the trend. It's no longer a solid uptrend. There's confusion here. There's accumulation. There's consolidation. And then once this is established, typically on something like this, when you're coming out of a bullish trend and you reach this point of accumulation, you break up again. Not in this case. This one broke to the downward, to the downside. And when it did that, it established a downward trend, okay? And we've touched on this downward trend a couple times. So what you're looking for here is points where the hammers are touching the trend line for a reversal, which is exactly what happened here. You had this hammer stick, it touched the trend line, came back down, and then established this typical reversal pattern, this typical reversal indicator, this indecisive doji candle, and then boom, it broke to the downside. And then you just ride this wave down. And that's pretty much it. I mean, that's ultimately what you're looking for. Now, granted, if the volatility were a little higher and we were touching on this trend line more and more, then you could be effectively trading these these hammer candles off of the trend line bounces and stand to improve your position significantly more, whether that's during an uptrend or a downtrend. During an uptrend, to me, I don't really see much sense in playing these swings, especially looking at a 4-hour chart. The swings aren't significant enough to me to justify the risk. But that's that, and that's pretty much how you look for establishing your trend lines, up or down. You've got a little bullish flag here that formed, broke to the downside, and you've got your hammers. Be back in a minute. All right, now we're going to talk about buy and sell area strategy. This is pretty simple. You can get really technical with it if you want. I personally I just kind of eyeball it. But ultimately, when you have, so right now we're looking at a 1-day chart. So every one of these candles is 1 day of exchange activity. And, you know, on a daily chart, your where you put these buy and sell areas are going to be kind of different. But ultimately, what you're looking for is a channel. You're either looking for a channel. You could potentially do this in a trend, because typically, if a price hits a particular point, especially in a sideways market, due to the volatility in Bitcoin, typically if it hits a zone, it's likely going to hit there again, and potentially multiple times over a period of time, until the market sentiment has changed or something significant has happened that starts either a breakout to the down or a breakout to the up. So this is the most recent chart of Bitcoin on a daily. So this is where we're at right now. We're currently at a dive. And on the daily chart, we've wicked down to basically where I ended this. But you can see here, we've had multiple. If we go back here, we've had multiple wicks into the buy zone. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, basically 15 potential buy zones. And then, you know, if I expand this out to be, you know, the same size, basically what I'm trying to find here is a pattern of wicks into a sell zone, okay? And in a sideways channel like this, it's very easy. But you can say, okay, well, I bought here, and then you could have sold here if you wanted. Maybe if you're kind of checking things out, you want to see, where things go. If you're playing it out, maybe a swing trade over a period of weeks or whatever, that's fine too. But resistance is up here. And we did wick to hit that resistance in this sell channel or this sell area, and then it came back down, and then the price changed. Now, technically, I would consider this a potential reversal hammer, which we just discussed. At which point we did reverse, and then the price came down. So the idea of this is you want to basically, it's almost like you can almost kind of look at it like a Bollinger Band, really. Like if you're trading against Bollinger Bands, it's pretty much, it's a similar kind of scenario to a buy and sell area strategy. But this you're doing manually based off of where you see the price action touching multiple times versus where, basically where you can buy and sell multiple times. So if I would have bought in here, I might have sold in there. And then I would be out for all of this. And then I might have realistically bought back in at this candle here. So I would have bought back in at 93.10. I would have rode this up, came back here. Maybe I doubled down, maybe I averaged down, and then I'm riding this up. And then I would have probably had sold and taken all my profits at 12,334. So this is something that it's a very simple strategy, but it's one that it's overlooked quite a bit. And you can do this. I mean, you can do this manually. And if you're swing trading on a day chart, you don't have to constantly stare at the charts because it's a swing trade. You're not scalping. Now, if I wanted to try and swing or day trade this or something, I might look at a 15-minute and then establish this on a 15-minute chart, which would look quite a bit different. On a 15-minute chart, I might be on a 15-minute chart, depending on my time period, I might consider this, my area. And if I'm looking at this zone, I might say, I might eyeball this as a potential buy zone. And then I might look at this. I'd probably look at this as a potential sell zone, which there's a lot less potential up and down, a lot more buy activity given the sentiment of the market. So you know, there's a lot more buy opportunity than there is sell. You've really only got one sell opportunity within that zone. If I wanted to lower it down below the resistance, then you know, I get several more opportunities in these candles on a 15 minute, and then on a 30-minute chart, you know, we're looking at a much more expanded time frame. So I'd probably bring my buy zone down here somewhere. Oops, bring my buy zone down to there, something like that. I mean, I'm spitballing here, but my sell zone. This is tricky. I mean, I would probably keep my sell zone somewhere where it's at. Let me get rid of this one. Oh shit, what did I just turn off? So, yeah, I might take my sell zone here. Something like that. And so you notice on the smaller time frames, your potential for profit on these wicks is going to be significantly less because you're not playing larger swings. So you're buying and selling in between larger individual swings. But if I'm buying down here, maybe if I bought here, I would have sold here and I would have made a quick buck. So, you know, establishing a new crow is born. David Holbert, welcome. So yeah, this is a very simple strategy. The less time you want to spend eyeballing charts, realistically, you're going to do on a larger candled time frame. You know, I think for swing trading, you know, using a daily chart could be very effective. But, you know, look, if you're buying in here, you got 1, 2, 3, 4, 5, 6, 7, 8. You know, 8 days where you might sell. If you were lucky enough and you held and you're kind of pushing your luck, maybe you're looking at the volume and you're saying, okay, volume is still strong, volume's strong, and we have some serious bullish momentum and it's picking up. And then you see this reversal hammer, you're like, okay, we're going down from here. As soon as that closed, I probably, well, I don't know. See, that's kind of the trick, right? You would have sold about here. Because if you waited for this hammer to close to truly form and confirm that it is in fact a hammer candlestick, you would have sold here. So if you bought here, let me see, is this, no, price range. All right, so if we bought in here and then we sold at this candlestick, you're still looking at a 27%, roughly a 27% gain on that trade, just using the buy and sell area strategy. And it's easy enough that you, especially when you're in accumulation phase or you're in a lot of sideways activity, you can eyeball it pretty easily. I mean, you can see where the ebbs and flows of the market start and stop in that sideways trend. So there you go. Hopefully that helps. I'll be back in a second with another tip. Okay, now we're going to talk about my favorite. This is an indication that I've used for basically since the very beginning. And it's one that it's almost fail-proof, but it is slow. So but I also, when I first got into bot trading, this is a strategy, an indicator that I would use for my bots, and I did very well with it. And you can use it on any time frame. But again, we're going to look at the 1 day, and then we're going to go ahead and look at a 4-hour. This is the crossover. This is basically with this isn't looking at candles or anything, but this is looking at the EMAs, the moving averages. And it's very simple, and I know I've taught this on my channel multiple times in the past, but for the sake of this video, we're going to do it again. You'll see up here I've got 2 EMAs. I've got a 13 and a 34, which are very common and very effective, especially in crypto. So basically what you're looking at is you're looking for the 13. The 13 EMA is this green line going through here, okay? And then the 34 is the orange. And what we're looking for are crossovers up or down. So if you look at this here, if I expand this, we're going to see this is the first touch where the 13 EMA crossed up over the 34, which typically means bullish price activity is going on, okay? Now, this is a lagging kind of indicator. This isn't necessarily leading. So, you could see, the closer some people try to front run this, they try to get ahead of it. And sometimes it works, sometimes not so much. But when that crossover happens, you can count on it probably hanging out for a little while. But that also depends on the time frame you're trading on. Again, this is on a day chart we're looking at. But when this 34 crosses up, this is basically where you're buying. You're buying here. Now you'll see almost at every time you're either going to lose a little or gain a little before this crossover actually happens, but it's a very solid confirmation as to this new trend. And so, you'll see some green, you were down, then it turned green. Looks like that was probably some sort of hammer candle, maybe a doji in the middle there. And then it was confirmed green. Boom. Then you get your crossover and the price starts to go up from that crossover. Now, from there, typically the larger the spread between the two EMAs, the more difficult it will be to send that price into a reversal of the trend that's happening from that crossover. And you'll notice here it was pretty sketchy. I mean, the candles were small. There wasn't a lot of big activity. It was kind of, maybe you'd call this an accumulation phase. And it was just slowly kind of getting rid of a lot of the smaller buy orders or whatever. And as we move forward, you'll see we're still above, and then boom, it starts to take off. And you start to see the strength of this, the width of these moving averages continue to spread apart. And they don't start to close until you start seeing some negative price action, but it never crossed back over. And then boom, at the height of this, all of this craziness, the spread got so wide. And in order for that wide spread to close up, you need a lot of sentiment the opposite way. You need some strong reversal. So if the price is going up very strongly, and there's a very bullish sentiment, well, then the spread is going to be wide, and it's going to take a significant size or a significant dump for that to change. And we see that start to happen here. And so as this price action starts to go down, you start to see this spread narrower and narrower and narrower until, boom, we get the cross. Now, you're going to notice price dropped a significant sum from, we were at a top here at 13,000, almost 13,200, and it didn't cross back down until 10,444. So there's almost $3,000 in there. Now, when you see some action like this, chances are, when you're trading this, if you're riding this wave, you should be absolutely changing your stop loss. So as this continues to rise, you might have got stopped out here. If you're just playing the EMA spread and you're playing these EMA swings, maybe you're not even trading with a stop loss. I don't know. I would. But the thing of it is if you're only playing the swings with the EMA crossovers, then you're going to miss some of these opportunities, right? So, but if you're trading with a stop loss, which I feel like you should in this instance, you're going to get stopped out here, and then you would buy back in, because technically this trend hasn't reversed. You're just basically taking some profit up here because you get a pretty strong red candle here. That's saying, look, this is going to reverse. This is a hammer candle that is signaling a reverse of this green price action. So it's probably going to go down further. So you might sell there. And then you're going to see this, and then boom, you're going to see some more of this, at which point you might say, okay, well, this is kind of a doji. This isn't, this is a doji after some negative price action. So I might say, okay, this might be an opportunity to buy back in. So maybe you buy back here, and then you're going to hold. And in that swing, you'll probably make, 5-8%. And then you're going to ride the wave back up. And every single day, you're going to basically increase your stop, increase your stop, increase your stop. And, this is a wick over a day. So maybe you caught this wick, maybe you didn't. If you did, maybe you set your stop loss somewhere around 13.2, and then the price starts to drop, boom, you stopped out. You got stopped out at 13.2. Now, what sometimes happens is, depending on the sales volume, the volume of the market activity, sometimes your stop loss is skipped right over because the price falls so quick, there's no market in between. So, and you see that especially if you're trading on smaller time frames, because there's just not enough time going by. On a day chart, with this wick, you've got 24 hours in this candle. So it's less likely that your stop loss is going to get kicked out or you're not going to get it. At which point, I would say it's pretty safe to say, you probably would have got stopped out around here. That trade alone, I'm sure, was pretty significant. Let's just say you even just got in. Let me see. Here's the hammer. So let's just say you bought back in here. You wrote it up. That's 70% gain just off of that one swing trade. Now, if you just bought down here at the first indicator, or the first crossover, that's a 290% gain just off of that one simple EMA indicator where you bought in and then you got stopped out somewhere up here. 290% increase, okay? And then once you get stopped out, you're going to watch this price action continue to go. Now, you might decide, you know what, I could buy back in here, improve my position that much more, and then ride this up to here. As this is rising up, you're setting your stop loss, you're rising your stop, boom, you get stopped out again. And you get stopped out before a major plummet in price action, which is then further confirmed by this crossover to the downside. Okay? And so, but realistically, if you look at this, not much changed, right? So if you don't buy back in here because you're saying, okay, this is confirmation that the market sentiment is changing and we're getting a reversal, the spread between the two EMAs isn't too strong, and then you get another cross up, and then boom, look what happens. It shoots up. You're changing your stop loss all the way up here. You're cutting it. Maybe you get stopped out as the price drops, so forth and so on. And that's the simple nature to the EMA crossover strategy. You can trade just EMA crossovers and nail it. Boom, 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 and make good profit every time. I'm telling you, when I'm running my bots, that's what I'm running. I'm running EMA crossovers or EMA spreads or something like that. Now, let's look at maybe you want to scalp some trades. You want to do this on a 15-minute chart. We'll see how effective a 15-minute chart is on something like this. On a 15-minute, on a 15-minute, because this is not leading, this EMA is a result of what's happening in the market. It's kind of similar, but it's much more active, I guess you can say. I don't think I would mess with the 15-minute, honestly. If anything, I would probably, at the bare minimum, I'd probably go with a 4-hour. I mean, 4 hours seems to be, universally one of the most potentially profitable, especially for day trading in crypto. Things move really fast in crypto. So 4 hours of activity is I would say it's probably more equivalent to what happens in a day chart in the traditional stock market. But here you got your buy in here, you've got your cross down, you've got your sell. This, if you were to trade this, trading this alone would get you 18.5%. And then you're looking at all this and you're saying, you know what, if I would have played this, here's the thing about this, and then I'll leave this alone. You buy in here, you're riding it up. Maybe if you're using a stop loss, you're going to get stopped out here, and so your trades are going to be significantly better. But depending on the chart you're using, you're going to be watching this like a hawk. Right? And you could look at this and you could try to gauge, well, the spread in these EMAs is growing, it's getting bigger. Maybe, I think you can try to eyeball things and take risks and say, you know what, I'm going to set my stop somewhere up here. Like if I'm watching this and I'm watching this slowly get more and more, getting wider and wider, I might set a stop somewhere up here, and that would have been a good call. But to be honest, it's such a tricky move and it's a risky move because you really don't know what can happen. I mean, this is a 4-hour chart, so it took, a couple weeks basically. Well, about a week for this all to happen right in here. And then we started to go down. And then we further went down. We finally got the crossover confirmation here. And then boom, it just dropped significantly. And then that channel started to spread. So, the EMA crossover strategy is very powerful, and it's very lucrative if you stay on top of it. Yeah, that's strategy number 3. I'll be back in a minute. All right, ladies and gentlemen, finally, we have one of the easiest indicators to use, I think, anywhere to make swing trades, and that is the RSI. So, to read it technically, basically, the RSI is an indicator that measures a trend based off of its size, speed, and duration of past price movements. Past price movements. So it's not a leading indicator, it's a lagging indicator. It basically just kind of tells you what has happened. But some people could easily just trade from the RSI in as simple a way as buying oversold and selling overbought. And that's it. There's really not much else to it. Even this, so if you're using TradingView, you just plug in RSI in the indicator, relative strength index will pop up, and it'll give you this. Basically, anything above a 70 is overbought. Anything below a 30 is oversold. And so basically what you're looking for at this point, when you see that the RSI, when it touches under oversold territory, when it crosses down below the 30, you're not necessarily buying here. What you're wanting to buy is right in there. Let's blow this up a little bit more. You're wanting to buy right in here. Basically, once it retouches. So it'll touch oversold, because otherwise you would have bought here and it would have fallen lower. And so you want to buy, or you want to watch it when it breaks under the oversold territory, but you want to wait for it to basically touch back to that line so that you know exactly when you're buying at the bottom of a reversal. And then the same is true for when you're selling. You wait patiently, and you could very easily just, the price can start to keep going up, 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 up. You can sell at any of these positions here in overbought territory, and you're going to be at profit, obviously. If you would have swing traded this, let's say, here's where we buy in, and then we sold it, looks like we'd sell it somewhere in this wick here. So that's a 22, almost 23% trade. Buying at oversold and selling at overbought. That's a 23% trade. And that's basically a 23% trade over a couple weeks. So 23% increase in your position, like especially if you're trading Bitcoin, 23% over some weeks, just trading on the RSI is pretty solid. But I mean, overall, these are 5 trading strategies that work very well. I mean, and they're strategies that you don't need to spend a lot of money on indicators. All the indicators, everything that I've used for this stuff, it's free. You're using candles. I'm using the Heiken Ashi candles for this. Some prefer other candles for different reasons, but I've grown to like the Heiken Ashi candles. Look, you could do this on any time frame. You could do it on a day. If you're doing it on a daily chart, your swings are going to take much longer. There's going to be a lot less activity. But if you're looking to make quick scalps, you could do something similar on a 30-minute chart. So again, I typically like to keep things at a 4-hour chart because it keeps things pretty accurate and still pretty fluid. Giving 4-hour chart, because of the volatility of cryptocurrency, that 4-hour chart can typically keep you But keep your button on the pulse of what's actually going on in the market without really suffering any drastic swings in any one direction over a 4-hour period. I'm not saying it's not known to happen, but if you're trading on a daily chart, you can get hit pretty hard with one long down bar or one down candle. So look, I mean, that's all she wrote, folks. Hopefully this is helpful to you. I'm going to be diving more into other strategies and other things moving forward. And, leave your questions, leave your comments. If you have questions about other indicators, if you have indicators that you really like and you'd like me to review them and look at them and learn how to make profit from them, or you just want your opinion on something, by all means, leave me a comment in the comments. I really like those comments. I always read them. I go through and I check them out. If you got a thumbs up on your comment, chances are it came from me first. Because as soon as I publish a video, I start going through the comments and I look at what everybody's saying. And I also have to prune any of the spam and things like that tends to get through. But that is all for now. I will see you guys soon. Until next time, guys, crow your coins. Thanks for joining me.